Hello everyone, Assalamu alaikum. I am Mohammad Abdul Samad Shanto and I am from Shahjalal University of Science and Technology from the Department of Computer Science and Engineering. So we will try to make a video today on money multipliers. So in this video we will explore how money is created in the banking system and how banks play a crucial role in expanding the money supply. Let's get started. So at first we will be introduced with money multipliers. So first what is exactly money multiplier? So the money multiplier explains how banks create money through deposits and lending, and it also measures the maximum amount of money that the banking system can generate with a given number of reserves. So, in conclusion, we can say that in economics, the money multiplier describes how an initial deposit or injection of money into the banking system can lead to a larger increase into the overall money supply. It's calculated as 1 divided by the reverse ratio, which is the percentage of deposits banks are required to hold as reserves. Then we'll try to know the formula for money multipliers. So, what is the formula of money multipliers? The formula for the money multiplier is 1 divided by reserve ratio. So, what is reserve ratio? A reserve ratio is the fraction of total deposits that banks must keep as reserves. So we can make an example. So as an example, we can take reserve ratio equals to 10%. So we can convert to decimal. We will get 0.1. Then the money multiplier should be is equal to 1 divided by 0.1, and that will result 10. So we can get the value of money multiplier at this moment 10. So this means $1,000 of new reserves can generate $10,000 in total money supply. Then we will try to know how is money created. So in economics, the money multiplier describes how an initial deposit or injection of money into the banking system can lead to a larger increase in the overall money supply. It's calculated as 1 divided by the reverse ratio, which is the percentage of deposits banks are required to hold as reserves. So we can understand properly by this animation. So we can see that the process of money creation. So the process of money creation, we can see at first commercial banks and lending. This is the first process. Then the loan process comes. Then comes the money creation. After money creation, fractional reserve banking, then central bank influence, last booking money. So all these steps and process make money, and this is the process of money creation. So then we will try to understand at step by step. Previously we have taken an example about money multiplier, and we will try to understand the example step by step. So we can see a customer deposits 1,000 in a bank. So the bank takes 10% as reserve and loans out $900. So then the borrower spends $900, which gets deposited in another bank. So here the borrower is the first bank where the customer deposited $1,000. So the first bank will deposit $900 and will take 10% of the deposit which has been deposited by the customer, and spend $900 in another bank. So then the process again comes. The second bank keeps $90. That means 10% of $900 which has been deposited into that bank. So 10% of 900 is $90. So he will keep, or the bank will keep $900 $90 from the $900 as 10% as reserves and loans out $810, and this cycle continues expanding the money supply. So that's the step-by-step process how money is created. Then we'll try to explore some factors which affects money multipliers. So the first factor is reserve ratio. So we already know about reserve ratio. What is reserve ratio? Several factors influence this effectiveness of the multipliers. Reserve ratio is one of them. So reserve ratio, when a higher reserve ratio means lower money multiplier. That means if the reserve ratio is higher, then the money multiplier must be lower. That means it's a reserve relation, reverse relation. So then we can get cash leakages. If people hold cash instead of depositing, the multiplier effect weakens. That means if people hold cashes instead of depositing, if they don't deposit and they hold their cash, they hold their money into their hand, uh, then the money multiplier system, that means the multiplier effect weakens, and that means it make the money multiplier system weak. So then we can see excess reserves. So excess reserves, if banks hold more than the required reserves, less money is created. So this is also a reverse relation. Then we will try to know about some real world applications of money multipliers. So at first we can see monetary policy. Central banks control the reserve ratio to regulate money supply. Then we can see inflation control. More money in circulation can lead to inflation. Then banking system stability. Ensuring banks hold enough reserves prevents financial crisis. So this concept helps us understand how money circulates in an economy and how banking policies impact economical growth. At the conclusion, we can say the money multiplier plays a crucial role in determining money supply. Central banks use reserve requirements to regulate economic stability. Understanding the money multiplier helps us grasp how bank influence the economy. I hope this video helped you understand the concept of money multipliers. If you found it useful, don't forget to like, share and subscribe. Thanks for watching.